some idea of what they should be doing for you. So that'll give you some ideas. So the course is for those who want to determine whether you want to invest on your own or you want to have a family member assist you. You'll have some awareness of what they should be doing. Or if you hire a financial advisor, it's our opinion that that person should be a fiduciary working for your best interest. And we'll talk about what he or she should be doing, in our opinion, in the investment process. Or you may be undecided, and this may help you decide, wow, this is fun, this is exciting, I want to manage my own money, plus do your own financial planning. Or you may throw your hands up in the air and say, look, I want to go travel, I want to do things. I'm going to keep working with or find a fee-based financial advisor who I can hire to do this stuff for me, that's not going to turn around, try to get me to buy some high-cost annuities or non-traded real estate program or something. I just want somebody that works more like a CPA or an estate planning attorney, and that may give you some ideas. But I believe that you could read this book cover to cover, and other books, of course. But if you have it in you to do your own investing, I believe you could do it with the help of this book as educational tool, not giving you specific advice, disclaimer, but other books as well, and take other classes. So many of the people listening are doing their own investing, and the only time they'll give it up is, and I've had some do this, by the time they grow to age 90 something, they say, look, I'm not remembering, I'm going to hand this over to somebody else. But generally, you could be doing it yourself. Okay, so I'm going to go to some slides, and then at the top of the hour, I'm going to try to go to the Morningstar report to help us with that. But let's take a look at some slides here. The first one is talking about whether you want to do your own investing, or you want to check with an advisor, or you just want to learn more information. The bottom line is, if you've been doing this for a while, it's great, but you're going to have to relearn some of the new tools that are out there. In the past, you could buy individual stocks and bonds, but we know the stock has the risk of bankruptcy, going out of business, and the bonds have the risk of default, going out of business. So you need to buy several different stocks and high quality bonds. But at one point, GE had AA or AAA rated bonds, and at another point they weren't so great. And if you waited for them to mature and got all your money back, fine. But if you sold that GE bond when it dropped in credit rating, you would lose money, because a buyer doesn't want to buy a B-rated bond when it used to be a AAA. You pay the AAA rate, and then they're going to pay the B rate, meaning it's a higher risk for the new buyer. So buying individual stocks and bonds, that's fine if you've got the time. And we always say, I have the time to watch them. Well, I don't know how you're going to control them by watching them, but it's one thing to keep an eye on what you're doing. So we recommend you buy into investments if you're not going to create your own. If you're not going to go out and become a real estate developer, or you're not going to start businesses in your garage, I wouldn't be a venture capitalist unless you're an expert at that, by giving new businesses money that could go out of business. So the next best thing is for us to buy stocks and bonds, but package them by way of an investment fund. There used to be mutual funds we'll talk about, high fees, commissions, all that. That's in the past. Now there's exchange traded mutual funds. They could have high fees, but we'll show you what to look for in the new exchange traded mutual fund industry. There's a lot of choices. So in the next thing that we wanted to point out is, when we do the investment process on your own, or you have an advisor or family member, you or they need to be very aware of your financial planning process before you actually start investing. We want to make sure that we're very aware of your personal cash flow, obviously. Now, most of you might be retired, so you know exactly what your expenses are and the income coming in. But it's always a good idea to plan. Are your bills going to be going up? Yes. Our electric bills are going up. We got something in the mail, said, pick this plan because we're going to raise your rates. Or you go to the store, it's shocking, we have inflation. So that's a problem. If you have a fixed income and inflation goes up, we all know what the problem in that situation is. But it's a good idea to plan ahead, because maybe you haven't taken Social Security yet. You can budget that into the future. Should I take it at 66, 67, or 70? That's a whole nother discussion. If I'm 80 years old and inflation starting to pinch in on me? Should I use some other tools out there that normally we wouldn't recommend? I don't like reverse mortgages, but if you're backed into a corner and you have no other choice, and we tell the kids, hey kids, I need some help, because if I don't get it, I might be using up the equity in my house. So cash flow, very important. We're not going to spend a lot of time here, but in the book, it does talk about planning future cash flow where your income might be going up, or maybe you have a note on an old piece of real estate that's going to end in a year or two, and that income stops. Personal cash flow. Insurance, not going to spend a lot of time, but the biggest thing for a lot of us right now is long-term care. A little late to go buy it. It could be too expensive, but a lot of you may have worked for the state. Do I drop this policy that's going to go up in price, or do I carve out what works for me to keep the premium the same? Whole nother issue. All the other insurances I won't bore you with, but we'll talk about some that you need to increase and some that you might decide to get rid of. Estate planning, again, we're not going to spend a lot of time on each of these diagnostics, but the book does tell you to go back and look at these before we get excited about investing your money. If you don't have the right title on your accounts, that could be problematic. I had a client pass away a few weeks ago. Her spouse was not listed as the beneficiary. Her advisor tried to send her a change of beneficiary form in 2001, 2019, and on and on and on. And they never responded. So now the husband is not the beneficiary to the IRA, and they're going to have to do a lot of finagling to try to make that happen. Estate planning documents, you know about a will and a trust. The durable power of attorney is important, and there's a lot of other things there in the chapter of the diagnostics. The first third of the book is about financial planning, and it talks about the diagnostics. This book, this workbook, was written for this class. We want to touch on these little areas so we can responsibly go to investing, because if we don't look at these cash flow, insurance, estate planning, taxes, the old investments, how can we reasonably and responsibly create a new portfolio that's up to date if you have old problems that could blow up in your face? If you don't have enough cash flow and you can't pay your bills, if you didn't have the right insurance, your house burned down and you didn't cover it, or the car, something happens to the car, or a disability or a loss of life, estate planning, so on and so forth. Taxes, do we convert an old rollover IRA to a Roth? Well, does anybody know whether you should or shouldn't? Any opinions? My answer is, I have no idea, right? If this year you're going to have low income, but maybe it goes up because you start RMDs, mandatory distributions, when you're 72, maybe it is a good idea to convert some of your rollover IRA to a Roth, meaning pay the taxes now, let it grow tax-free. The biggest winner of that will be the IRS and the state, because they get taxes today, and your beneficiaries, because you pay the tax for them. But some people, maybe they're on a high tax bracket and it's better not to do it now. Maybe their income will go down in the future. So remember that personal cash flow. If you know what your cash flow looks like in the future, you can sit down with your accountant and he or she can tell you, this is a good year to convert part of your rollover IRA to a Roth because you're in a low bracket, but your income's going up, or vice versa. So these things we need to know. Just like when you go to the doctor and have a physical before they prescribe some exercise or drug, they need to know more about what's going on. So your workbook, the first third is about financial planning, looking at what you've been doing in the past and cleaning that up. And we create a diagnostic list and a punch list, as we call it. And then in the future months and years, you come back to your post punch list and review what you've done and what you need to get done. Meaning, do you have a living trust? No, I don't. Well, it's on the punch list. Now it's a post punch list because we've been bugging you about it every single year in the class. There's a ton of those things. And the beauty of the book is, in the back of the book, there are three pages, maybe four of to-dos. Minimum cash reserve, this insurance, that insurance, no, you don't need it. You just look through them and you answer whether you have these things, yes, no, or it doesn't apply. That's okay. It's just a reminder. It's a list. And when we're done with this class, you or your family member or your advisor should be able to answer 25 questions at the back of the book and get at least a 80–90% score on those questions because they're explained throughout the book. So the first third of the book is personal diagnostics. what you've done in financial planning in the past. And that takes us all the way to the punch list of, well, I got to get around to getting that liability policy umbrella on my car, my house, and my rentals and things like that. People, we don't want to think about those things. We just want to find out what's the next greatest exchange traded fund. Well, if we don't cover these things, we could end up losing everything or leaving it all to someone we didn't plan to leave it to. You spend your whole life, you've got the assets. If you're disabled or die, somebody may take over that you don't plan to take over. So we need to at least review your cash flow, your estate planning, taxes, and your old investments. You may have some old investments that need to be replaced, or you may have an old mutual fund that even though it's not a great fund, it's grown a lot, it's not in a retirement plan. We don't want to just tell you go sell it. Because it may still cause a lot of taxes. So you need a selling plan to ease the capital gains taxes over the years. And if the politicians are planning to change the taxes, well, then maybe I'm wrong. Maybe you should sell it that year and the taxes go up in the next year. So it's a big drama soap opera, but it is a lot to take in and it is important. We need to be up on what we think the tax laws might be next year. And they haven't changed because of politics so far. So once we've worked on the first third, we'll look at the second third of the investing process, of which are the best exchange traded mutual funds to buy. We'll learn the difference between an old mutual fund, let's say at a Vanguard, great company, but a new Vanguard exchange traded fund, or an old Fidelity fund versus an ETF with Fidelity and Schwab and so on. What's the difference? We have some fun little stories that will educate you a little bit more on the exchange traded fund, because some people that do their own investing swear by them and think the old mutual fund is horrible. Well, it's not horrible. It's just could be a slightly higher expense ratio, not a guarantee, might be longer to sell it. And there's some little nuances, but they're not horrible. Some of the old managed mutual funds, however, with the big retail companies, they could have a management fee that could be 2% when maybe it should be 0.25%. Who knows? So when we get to the process of selecting the exchange traded funds, CDs, bonds, and things like that for a portfolio, we'll talk about the portfolio construction. We'll spend a little time talking about when you create this portfolio or several, it might have a lateral integration plan. What does that mean? Let's say you have all your little old retirement rollovers and deferred comp combined into one big rollover IRA. Hopefully it maintains its investment insurance, not from loss of market, but from lawsuits as a rollover, something called ERISA. When we have money in there, we need to look at it. We'll talk about lateral integration, meaning short-term investments in case the market crashes and you need to fix your roof. Intermediate term horizon investments that I might be able to leave that there 3 to 5 years so I can now start going for a little more growth. But if the market crashes, maybe at the end of 2 or 3 years, the dividends helped reinvest and then it dropped, but at least I didn't get hurt too bad if the market was down when I pull it out. And then the long-term lateral integration plan is some funds that ought not be sold if the market crashes. Might be a growth stock exchange traded fund that's down a lot. You could sell it and buy another one that's down, but you don't want to sell something that's down and buy something that's up. That's a little silly. So the lateral integration plan does not mean you're tied into anything and you have to wait. It just means that some of the funds, a small percentage, have very short-term objectives and they're going to earn 0.5%, maybe almost 1%. Money market funds, CDs, short-term bonds. Some of them have a longer horizon, short-term bond funds. I wouldn't go to long-term bond funds right now. We'll talk about that later. Maybe balance funds will have stocks and bonds. So if you have an emergency, you need to liquidate it. They could be down, but not as much as the next group, the long-term investments like the S&P 500 or the total stock market index fund that has maybe 2,500 stocks in it. We'll talk about the S&P. The reason it's done so well is most of it, meaning almost a third or 28% or so, is in tech stocks. But if those tech stocks go down, we've seen recently that they've declined because of the fear of interest rates going up. Tech stocks are owned with the intention of someday I'll get a big dividend. And if interest rates start going up, people get impatient and they say, I'm going to go buy CDs, especially I mean, they pay practically nothing now, but you imagine if we got back to 3% CDs, there could be a lot of money leave the stock market because why take the risk? I'm going to go get 3%. I don't predict that. I think it's going to be a while, and all I can predict is what I see on the news media and all these so-called experts that half end up being right, half end up being wrong. Lateral integration, time frame investing. That's important. If you were Warren Buffett, who cares? I'm going to put everything in the long-term bucket, all stocks. The market could drop in half. He's always got money. But the rest of us, if you are required to start drawing money out of your IRA at 72, or maybe you are now, we want to have some powder dry. So if the market crashes like in 08 and it takes 5 years to recover, we need 5 years of distributions, or at least funds that take a little bruising instead of a lot of bruising, and we can get out over time. So the financial planning process is not the investment process. The investment process is part of the financial planning process. And financial planning, I think a lot of us think that's for young people trying to build an estate. That's true. Financial estate planning, let's call it estate planning. We're trying to retain what you've got. And so we need to do the first third of your workbook, study, read it, get familiar with that. The second third, we're now having fun because we know we want to use low-cost exchange traded funds and maybe some slightly managed, but index funds are low cost and they're good. Then we look at the vertical integration plan. And that's a little more specific on the types of funds. So if you imagine a pyramid, we'll show you this later, that's broken into 3 levels, equal levels. Obviously, the base is wider than the middle part, and then the top is very small. We'll talk about the base being total market index exchange traded funds, meaning bonds of every sort in a total market exchange traded bond fund. I'd prefer short-term bond funds for now because interest rates might go up and bond values will drop. But at the base of this, we want the largest total market index funds possible. A total market stock index fund might have 2,500 stocks in it. We might have a total international stock market similar, and we might have, if there is one, a total global stock market fund. But the base of the pyramid, we want the biggest funds that have the most money in it because they have the lowest cost and they don't have a lot of turnover, so they don't need to be small and agile. And we might have one with Fidelity, we might have one with Vanguard, we might have one with Schwab, and we might have one with iShares. I'm just saying, because I don't know what could happen. What if another plague breaks out in Vanguard and they can't get somebody in there to get you your money? So we would like a pyramid, 3 levels, 4 different companies, but total stock market, total bond market index funds, preferably short-term bonds at this time. The middle part of the pyramid, exchange traded funds that are very passively organized or rebalanced. They might have small, mid, large, international indexes in it, but they rebalance every quarter or once a year. Little passive management things. Or it might be a specialized index like small companies versus large, utilities versus oil or something. So the middle part of the pyramid are more specific, less broad-based index funds and passively managed. There might be smart beta. You'll see some of these things in the book to learn about those. And then the top of the pyramid are the hands-on managed funds. Well, if they're going to do a lot of management every day, buy and sell or look at things, you're going to pay a high expense ratio. Why would we do that? Well, if they allow a new exchange traded fund to buy digital currency like Bitcoin, they're not out yet. The SEC is still mulling it over. But if they do come up with one, and let's say you always wanted to be in Bitcoin or digital currency, you might start off buying a managed exchange traded fund whose management fee might be 1%. I mean, that's like 10 times higher. But if they're doing something to protect you, especially they have your cold wallet passwords and they're not going to lose them, if they provide value, then fine. You go to the top of the pyramid, the smallest little triangle, and you buy managed funds that do something to protect you. Another type of managed fund might be junk bonds. Maybe it's a little too dicey out there. I don't want to buy junk bond fund index because things could get a little scary. So the managed funds are at the top of the pyramid, the smallest little pyramid. They have the highest expense ratio. In the middle part are the passively managed or allocated index funds or funds that have different strategies, but they're still low. And then the bottom is the total market index fund. Well, why do we do this to try to get the fees down? I don't get it. You just said one has a high expense ratio. Is my overall average going to be high? No. The biggest, broadest group of funds is at the bottom. These total market index funds are massive, so therefore they can bring their expense ratio down. I know of one that charges only 0.02. A couple others, 0.05. That's almost like no management fee because they're so large. And because they're not buying and selling, they're just buying one of everything. They don't need to charge a high fee to hire a lot of managers to buy and sell. So at the base of the pyramid brings your overall portfolio costs down because most of your money is in low cost, broad market index funds. The middle part of the funds might have an average expense ratio of 0.10 to 0.25, maybe 0.35 if they're passively managed, but there's always new ones coming out. And fortunately, these big, massive companies I mentioned, they'll wait for some other small company to start a new exchange traded fund, watch it be successful for a few years. And once they see that, okay, it looks like that little fad's going to work, they'll start their own at a much lower expense ratio. So you might start off with an exchange traded fund over here, getting involved in Bitcoin, let's say. And someday when Bitcoin becomes massive by the investor standards, somebody like Vanguard might step in and then start their own fund. But because they're Vanguard, they can raise a lot of money very quickly. And I would assume most likely have a very low expense ratio. So they're not the first cowboy to go through the door and risk getting shot. Usually the big companies take their time, and some of the smaller ones or some of the bigger ones that are known for doing new funds do that. So lateral integration, short-term, intermediate, long-term horizons. You can get in and out of these funds daily if you use exchange traded funds, whether it's in an IRA and you can trade without taxes, they're deferred, or outside of an IRA, you may or may not have taxes. And we'll talk later about the exchange traded fund being more tax efficient. And the vertical pyramid is total market index funds, preferably short-term bonds right now, passively allocated, passively managed, and then a handful of managed funds. Even that's a lot to take in. So please, do we have any contributors? Anybody have a question? I'm just that good and you love watching me. All right. Okay. So I'm going to move on to the next slide because I don't want to get in trouble for rushing you. But the good thing in some of these slides, we'll get there. As we get into it a little further, this little blue box will tell you which page that you can look to the book to research and read up on what I talked about a little bit. And like Marcia said, if you'd like a hard copy, we have one that you can highlight and write notes in, and or the digital or the hard copy has 3 pages of to-do list if you need to get look at that list and see if you're caught up on everything. So then you can go back to having fun investing. And then there's a 25-page questionnaire. And there's also lists at the beginning and the end that tells you what, in my opinion, if you hire somebody or have a family member, he or she should be doing. And there's also a list of what things they should not be doing. And there's also a website and a phone number for the SEC where you can look up anybody that is a professional that wants you to be a client. If you hire somebody, you should be able to look them up and get their history of examinations, as far as tests, qualifications, and if there's any complaints or they've ever gotten in trouble for doing anything wrong. So, and there are some that if it's not financially related, you would be surprised what things you might find an advisor has been in trouble for. I always joke, yes, I've been in jail many, many times, but I used to work as a guard, as a reserve deputy for Sacramento County for 30 some odd years. And I sure wouldn't want to go there as a guest. So something to think about. So phase one, financial planning, phase two, creating the portfolios, and that's the fun part. But phase three is some more work that you, your family member, or an advisor needs to follow. We will tell you what task you'll need to do every single day. I'm not going to go into it right now, but we have something for you that you need to do every day if you manage the money yourself. If somebody else manages it, they should be able to tell you they do this task every day. They should also know exactly what to do on a weekly basis. We have a list of things for you, your family member, your advisor, that he or she needs to be doing every single week if they're managing all your money. If not, fine, hire an advisor, fee-based, know what they charge, see if there's value. I wrote this book also for other advisors so they could have a process so they could justify the fee they're charging if somebody hires them, because it's okay to pay somebody a fee, your accountant, your attorney, or whomever, but there's a saying, if I can get it right, price is only in question in the absence of value or something. If you get to see everything that needs to be done, in my humble opinion, and they're doing these things, if you want to travel and don't want to bother with it, pay your family member a fee or pay an outside advisor to do it, but at least you'll know what he or she should be doing. Monthly, there's a process that they need to be doing as well. I'll go into great detail, but the fun part of this is it gets to be a little bit more about shopping for investments. Then quarterly, there's something that they need to do, and it's related to analyzing the investments you already have and make sure that they still hold up and new ones aren't better, and you don't want to replace them, or do you? Because there are old mutual funds out there that normally we would say sell it, the fees are too high, and convert it to an exchange traded mutual fund. But the problem is there may be taxes due. Well, a lot of the big companies are actually converting the old mutual fund to the new exchange traded fund without a tax liability. They're doing that because they don't want to lose your business. If they don't do it, you might sell that old high expense fund and buy somebody else's exchange traded fund. So they're reluctantly converting some old mutual funds to exchange traded funds. And if you have them, that's great. You don't have to make the sale and pay the taxes if it's outside of a retirement plan. So things for you to do quarterly, that has to do with reviewing everything that you have to make sure that there isn't something else out there better. And when I say better, I don't know what a better fund's going to be. I say better in that the managers haven't left. It's a reputable company. There's enough shares out there that when I need to sell it, there'll be somebody to buy it. Okay. The expense ratio is relative to what they're offering, and that's fair. That means better. I couldn't tell you what the best fund's going to be out there, but I can say this fund is better than that one if they both do the exact same thing, but this one has a lower expense ratio and a bigger volume of trading and more money. Because when you need to sell, we got to make sure somebody's going to not only buy your shares, we don't want there to be a big spread between what you paid for it and what you sell it for. That's scary. The old mutual fund is a little safer. So we need to realize that this is the Wild West. It's not unfair. The SEC is watching out for you, but we could make some mistakes. So we need to watch our funds on a quarterly basis. And then if you do convert, be careful. Biannually, that's a rebalancing time. We'll show you how to look at that. And do you have any funds that are up too much? Now, you can always rebalance any day you want. I don't believe a computer should make that decision for you. It might sell stocks and buy into long-term bonds. Long-term bonds, are you kidding me? They're very sensitive to interest rates going up. They could hurt you. But then again, maybe you have a lot of risk in stocks. So any more, we might, on a biannual basis, I'll talk to the investor, see where we're coming from. And if they're nervous, I'd rather sell some stocks and put it in non-performing cash for a while. And that the dilemma there is, as you know, I put CD money in the bank and you're earning almost nothing, but then inflation goes up 7%. In the short term, you lost 7% of buying power. To heck with that, I'm going to the stock market. But in the short term, if interest rates go up or anything happens, you could lose substantially more than that. So parking money in cash is a short-term shelter, but it's not something that's going to help you long-term if we see inflation. But watch out for the investment people to say you need to buy gold, you need to buy stocks, you need to buy real estate, protect yourself from inflation. Sure, 10 years, 20 years from now, I totally agree. But in the short term, inflation could go backwards. We could have deflation, prices could crash, your stocks could fall. And if you didn't create that lateral integration plan, where are you going to get the money? Remember recently in 2020, the government allowed people to take a year off of their mandatory distributions. Well, why did they do that? Anybody know? You know, but you don't want to share? Anyone? The reason that the government said you don't have to do your mandatory distributions in that particular year is because if you had everything invested in one stock that just dropped 50%, that would be catastrophic, right? You'd have to sell shares that drop 50%. Or if you had all your money in the S&P 500, hey, somebody told me just buy the S&P 500 and forget it. It did drop 65% in 2008, and it took 5 years to recover. So if you were all in the S&P 500 in 2020, it dropped as much as 38%, came back, and it was down 25%. The government gave those people a break not to be forced to liquidate their IRA 4% a year, let's say, and have to pull out twice as many shares. So we need to be aware of your cash flow process and your liquidity needs and your risk tolerance. Anything that you want to invest for inflation, you need to be aware that that could be wildly volatile. And if it's in the long-term bucket, as you call it, that's fine. The only thing you have to do if it crashes, confirm it's a good fund, expenses, management, company, volume, trades. Okay, all those look good. So I need to hold on to this, or if I need a change, you could sell that S&P 500 fund and maybe buy something else, a small cap fund that's down even more. That's fine. But if you sell the S&P and then buy treasuries, obviously the market recovers. And yes, you had a permanent loss. Annually, we'll talk a little bit about what you need to do, but that's just a review of the financial planning and estate planning process. People don't realize what the administrative staff do at a bank, at a brokerage company, at a firm. I think about, 4 people helping behind the scenes because somebody might need to do your required minimum distribution. So somebody's got to calculate that, fill out the forms, get the bank form signed, send the money to the bank, all these details. You can do it, but I have a list at the back of your workbook that will let you know what to be prepared for. We all know that we need to start our mandatory distributions from our IRAs now at 72, used to be 70 and a half. And if you don't take it and years go by, the government can penalize you 50% of what you were supposed to pull out. I haven't seen it done, but we scare people. Oh, that's going to happen. Be aware that if somebody tries to scare you into that, it is a scare tactic. I had fun with it in classes, and I'll use it now. It's, you better start at 72. And there's all kinds of little details. What if my spouse passed away? Can I transfer one spouse into the other's IRAs? Yes, you can. Do you have to reset that? That's all stuff you have to do on administrative process. I hope you like administrative work because you're going to get a lot of it. There's so much more. And that's why this book is great for you deciding that you can take that on. You used to run a state office. You can handle this, or maybe you're sick of it and you want to go on vacation. That's up to you to decide. So these are the things that we need to do on the third section of the book. First one is financial planning. Second one is portfolio construction. Third is, what do I do now? And these are just the portfolio reviews that we need to do. We need to look at the post-diagnostic, meaning how does everything look? And then what's our punch list? What do I need to get done? And the post-punch list is after all this stuff is done. So you need to have your to-do list. I know there's things in the back of your mind that, oh, I need to get this done. I didn't update my trust, or I didn't get a durable power of attorney in case I'm incapacitated. Bill said something about uninsured, underinsured motorists in case I'm the victim in an accident. What? I don't remember. So you just go back to the book and look it up, and I'll give you, to the best of my knowledge, some recommendations, and you can continue reading and check off the list. Did I maximize my auto insurance in case I hurt somebody else? Did I maximize my uninsured, underinsured? I have stories about those things that'll make you very nervous and try to get you to do it. List of possible goals as we move on through the investment process. Okay, I got to do the financial planning and the estate planning, boring, but I want to go back to my goals. Well, this is a list of goals that many of us would have. You can just glance over them. You might have all of them as goals. That's an intricate plan, but some people might have just a few that they want to deal with. Very interesting. I was in business I started learning about this business in 1980. And obviously, well, you guys are too young, but back then we had massive inflation taking off. And remember, your parents bought a house and the interest rates were 16%. I bought a house at 8.75, but it was a low income house in Del Paso Heights. But most people were paying 16%. And I always joke about what's the best time to buy a house if you have to have a mortgage, when interest rates are high on mortgages or when interest rates are low on mortgages. Anybody have an opinion? When should you buy real estate? When mortgage rates are through the roof or when mortgage rates are super low? Good. I'm glad nobody answered because I don't want to beat up on you, but it's actually when interest rates are super high. What? Well, when people had to pay 18, 19% mortgage, that house today is worth $750,000. Back then, it was probably worth $80,000 or so because buyers couldn't afford to pay a big price and a big interest rate. So the seller had to drop and drop and drop the price of the house because most buyers couldn't afford the mortgage. So they kept dropping the price of the house, if they did, to the level to match that person's budget when they're paying 18%. Now, the beautiful thing is, you know what I'm going to say. Think about it. I bought a house at $80,000 for the price, and I'm paying 18% on the mortgage. Oh my gosh, that's $2,000 a month. That's outrageous. But obviously, as you all know, you're thinking this in the future when interest rates ease on down, you're going to what? You're right. We're going to do what? I heard somebody say it. I heard that. Refi, right? So you're going to refinance and drop your payments, but you paid the 80, 90,000 for the house. And as interest rates come down and new buyers can afford that mortgage rate and afford to borrow more money, you just keep raising the price, and look where we are right now. So I would guess to say that real estate prices are the highest they're going to be for a while, unless there's other reasons. People like California, they want to move for this reason or not. And by the way, those of you that don't like California, I understand, but California does have some nice points. Property taxes, Prop 13, they don't go up for the original owner. There's some benefits for the beneficiaries, but they can be reassessed when mom and dad die and the kids inherit the house unless they move into it. Property taxes. California doesn't have an estate tax, believe it or not. That's kind of cool. So not everything about California is bad. Obviously, the weather is good, and there's a lot of other information. So these are some of the goals that people might be looking at. So phase one, the financial planning process, we talked a little bit about. And we talked about this cash flow process. So I'm going to move forward on some of these. There will be years that when you go back and look at your cash flow process, we want you to try to predict the future 1 to 2 and 3 years, but also look at the 10th year. So we're going to be looking at, and here's what I wanted to show you on this page. Page 14, if you want to look at this just for fun, look at your income coming in your budget, and then just see where you are trying to project where you'd be in 10 years. Cost of living, cost of healthcare, all that stuff goes up. The insurance, review all these things. We've talked about it. I don't want to bore you with them, but the book will tell you some details about them and what to look for. I know it's boring. If you can't sleep, look at these policies. But if something happens and you don't have the coverage, it's going to come out of your investments. Estate planning, as I mentioned, read through the will and the trust to get some idea of what it says, so you have some idea of what's going to happen. There's a lot of attorneys out there that want to come in and help you update the will. Well, that's called restate the will. You don't have to do a complete new will and trust. They'll restate the trust, but it could be very, very expensive. And then now the estate planning attorney might be mentioning some really complex trusts that you may be scared about. You don't want to give up your assets and have an irrevocable trust and you're just the beneficiary. And then if you go to long-term care after 5 years, Medi-Cal has to pay the bill. Well, the estate planning attorney means well, but that scares the heck out of people. So if you become more aware of what you're doing with your trusts and your wills, maybe when that day comes about, you might be willing to go for it. But it is a scary thought. Even changing my house to my name and my living trust where I'm the trustee, it's like, oh no, I don't have control anymore. Well, yes, I'm the trustee, but if I'm extremely older and I do an irrevocable trust, I've given up all my assets to this trust. And that's a little scary thought, but it could be the right thing to do. Taxes, we'll look later at the tax favored funds. We'll find that ETFs are a lot more tax efficient. Deductible retirement plans, do you convert to a Roth, and so on. Some of you still have a tax deferred annuity. Well, I would encourage people to do your homework and not buy annuities. I think if you do your homework, you won't want to. But if you still have an annuity, I would encourage you not to just blatantly sell it. The tax liability and early withdrawal penalties could lop you off at the knees. If you have an old fixed annuity, the good news is the minimum interest rate that they used to laugh about and think rates will never get this high, this low, could be 4%. So if the company's in good financial shape, I usually would recommend keeping it. Unless it's in an IRA, then that's redundant and highly inappropriate that a tax deferred anything is in an IRA because the IRA is tax deferred. So it's a good idea to just get a feeling for all these things and update them, but do it yourself and dig deep, or have a family member or an advisor dig deep and read these things and make sure you know what you've got. Later, we'll briefly talk about retirement plans. You might have a profit sharing plan, 401k, or employee stock option. Most people in California, unless you're in Silicon Valley or something, might not, but you might have a tax sheltered annuity, 403b if you're somebody at a hospital or a school teacher, deferred comp for the state, and so on. These are just sidelines. I don't want to bore you with them, but we need to at least do the section 1 on the financial planning so we can enjoy section 2. We'll talk a little bit about different funds, and these are funds that if you have an old thrift savings account at the government's plan, or you have an old 401k, maybe you want to roll that to an IRA. And of course, every insurance agent and advisor and broker and everybody wants you to roll it over. The good news is the retirement rules now make sure that the advisor has good reason to roll over your old retirement plan. If you have the thrift savings plan, they can't use the excuse that the expense ratios are too high. Those are some of the lowest cost index funds around. But they could say, well, maybe that thrift savings plan doesn't have funds like this ultra short-term bond fund where I want to park some money. Maybe they only have a total bond market index fund that is down 7% since January because interest rates went up. I don't want to do that. So a rollover to an IRA gives you, I'm guessing, 25,000 funds to choose from. And where the old thrift savings plan didn't have the short-term bond funds, you could possibly do that. That's one reason to roll the money to a rollover IRA, but be careful, make sure you have a good reason. Also, floating rate income funds. These are triple B bonds and below, but they're short-term and the interest rates fluctuate up and down. They're more specialized. You're not going to see that in the thrift savings plan. They're not going to give you specialty funds. There's not enough people. They have to mass produce that thing for millions, I would assume thousands of employees. I don't know if thrift savings plan has a short-term bond fund, but if you had money that you didn't want to have in intermediate long-term bonds because they're at risk right now, and you didn't want to be in the stock market, I hope they have a short-term bond fund. I know they have a fixed account and will pay a set rate with less volatility, but they might not have short-term, high-yield short-term bond funds. I'm sure they don't have those. Those are short-term maturities. High yields mean lower credit rating. You might be willing to go out into the swamp a little bit for the credit rating, but you don't want to go out there with long-term bonds. We'll talk about bonds later. Multi-sector bonds, a little bit of high quality, low quality, U.S., international. Jenny Mae's Government National Mortgage Association. I don't think Thrift Savings Plan has that as well. Those are government-backed mortgages that can't go belly up, and they can adjust upward and so on. High yield bonds, junk bonds, utilities, international commodities, real estate, preferred stocks. These are all funds, and especially if you use exchange traded funds, I'm quite sure that Thrift Savings Plan doesn't provide a bunch of exchange traded funds. Most 401ks do not yet. They will in the future, but it's too much. One reason is if you have a big 401k, they want you to manage mutual funds, because then that managed fund will, I don't want to use that word, but let's say pay back the administrator of the 401k, give them part of the management fee. So the administrator could say, your 401k plan is free. Well, free isn't free. You're paying a higher fee on the funds, and then they're giving back part of the fee to the 401k administrator. And that's how you can do a 401k plan for free. Remember, free is never free, right? If you get a product for free, you become the product. We know that with social media now. Every time they want your email address or everything about you, you know they sell it to all kinds of other organizations. These are funds your plan may have held in the past, and we're going to look at some Vanguard funds today. We'll take a look at it. Your fund might not have low-cost index funds. They'll probably have S&P 500, so that's one gimme. They might have a total stock market fund, but I doubt they're going to have smart beta funds. All those is a little bit strategically allocated funds that try to get you the best return for the risk. Beta means risk. You'll find that out. Smart beta, strategic beta messes with smart beta. We'll learn about that in the book. It's all written about it. Multi-factor, all factors are as in a car, a factor might be a seat, and another factor might be the engine. The other factor might be the bumper. So the parts of the funds that is desirable, then they have multi-factor funds that they mix together like a stew, and they're hoping that you'll buy that exchange traded fund, and the manager who put together this concept gets 1/4%. So if they raise 100 million, they won't be in business long. They need more like 300 million. But if they get up really big, then it's easy money for the management fee. And everything's done for money, right? Any mutual fund that you buy, any investment product, you put money at the bank. Somebody on the other side is hoping to manage that money and get a fee. An annuity, an insurance company, believe it or not, they're not selling the annuity, the company, to get a commission from you. They do pay it to the agent. They just want to get your money into the pot. Then they can charge a management fee to manage millions or billions of dollars, the insurance company itself. Now, sure, they're going to have a surrender penalty and charge higher fees to recover what they just paid to the general insurance agent and their sales solicitor. So we want to know about all these different funds, but your old retirement plan might not. So these would be good reasons to roll over to a rollover IRA. If you do the rollover yourself, well, to heck with the SEC, you can do what you want if you're doing it. If an advisor is helping you do it and he or she's going to manage the money, or hopefully not sell things for a commission, and definitely not, hopefully not an annuity where they say you don't pay a commission, but when in fact the fees are so radically high, you'll pay the commission several times over the several years. There are no load annuities. If those of you love them, you could find them, but we want to avoid the ones with the high fees. The reason that the annuities have all these fees is they're not popular, so they have to pay salespeople to bring them to the insurance company. If there are big no-load annuities that you can buy on your own, go for it if you like annuities. Then I say annuities aren't so bad, because Social Security is a big whopping annuity, and I'm not going to draw it until I'm 70. And if I die early, those of you that are all younger than me will get my money, and I'm okay with that. But if I live from 70 till 100, I want to get the highest amount I can do, but I can afford to do that because I have other plans. If I was retiring at 62 on a disability, then maybe I'll take Social Security disability, and it precludes me from going to age 70. See how dramatic and how much of a soap opera all this stuff is. What your advisor should be doing to justify the fee, we talked about that. He or she should be doing things daily, weekly, monthly, quarterly, biannually, not just in your account. Maybe they're looking at everybody's accounts at the same time, but they should be extremely active, because not only are they charging a fee, but they have limited discretion on telling you how they're going to allocate based on your request. This is on page 55. And if you don't want an advisor, but you want to be tied into what should I be doing, then you just look at all these little processes. They're not that difficult, but it's a reminder. This is your workout class. I should do a video. Okay, folks, daily, here's what we do. Get going. And then every week I should check in monthly, quarterly, and biannual and annual. But you can do this. It's all in the book. Questions yet? Anybody want to challenge anything? Okay, lastly, before we go to the Vanguard portion, the fun stuff, we'll look at the, not Vanguard, but Morningstar, excuse me, Fidelity, Schwab, and everybody else. Converting your existing IRA, you'll see on page 58 that if you have somebody encouraging you to do a rollover to their managed rollover IRA or whatnot, then these are some of the things that you should be doing. And then if you're converting from an IRA to a Roth in the process, be careful. I've heard some radio shows say, this is how you can live tax-free in retirement. These other advisors don't know what they're doing. But when you look at what they're advising, they're saying convert your existing IRA to a Roth. Well, that's nice, but that's a massive tax bill. They're not mentioning that because once you get to the Roth, then they're saying someday you can draw income out of the Roth tax-free. And oh, by the way, let's have you buy some life insurance and all these other annuities. So remember that old saying, if it's too good to be true, it's too good. There's nothing free in this world, so we have to be very careful. So converting or rolling over an old 401k or TSA or any retirement plan to a rollover IRA, great idea, more choices, but make sure if somebody's encouraging you to do that, you go back to the list of reasons why you should do it and what they should be doing. If they're saying convert your old IRA to a Roth, great, but this is a list of reasons why you should and why you shouldn't. I'll let you read that on page 58. It's all relative. If I do my job right in teaching, or let's say as an advisor, I speak with a forked tongue. Hopefully you don't think I'm a snake, but I speak with a forked tongue. What's right for you today might be different tomorrow. What's right for you might be totally different for somebody else. Warren Buffett, all stocks, great, go for it, knock yourself out. The rest of us, you got to start distributing money in a year or 6 months, or you need to do it now. We can't afford to have that money sitting in high-risk stocks. Long-term stocks, yes, that represents the overall economy, goods and services, buying and selling. All of us have to go to the grocery store. Long-term, hands down, I'm sure the stock market will always be the best place to be 10 years and beyond. If I could put you in a time capsule, wake you up in 50 years, we would go to a small cap growth fund index. Whoa, 50 years, I'm sure, my opinion only, that'll do extremely well, 50 years. But if we invest into the small cap growth with all your money today, small cap funds have an average volatility, my opinion, what I've seen, of about 35% average. They could be down more than that or less than that. And when you look at the S&P 500's average volatility at 16, 17%, but they dropped 65%, I think it was March of 2009 or so. Oh my gosh, that's a lot. So we need a backup. You don't go on with your backpack over the mountains without food supply. Yeah, sure, you want to catch the fish and cook it, but you're still going to put some jerky in there to make sure you don't do it. That's the financial planning process. So take a look at these things. Make sure what you do, there's a good reason for it. Other things, I won't go into great detail of why your own home is a good investment. It'll talk about this on page 59. And there's a lot of changing information on that. Prop 19 change things you'll want to be somewhat familiar with. I do think real estate is a great long-term investment, but the question for us now is, what if long-term has already passed and I'm not going to make it on my assets? Should I use my house as a reverse mortgage? Usually I would say no, but in an emergency, if you're in dire straits and you don't want to leave the house, then you threaten the kids jokingly, I'm going to get a reverse mortgage because I'm running out of money. They should run to the rescue if you have children or the beneficiaries. Or if you have to get a reverse mortgage, fine, but it's not going to help financially in the long term. But if I'm 90 years old, what do I care? Okay, so if I do this correctly, I'm going to slide this one over.
Okay,
And-
Bill, before you go on,
Yes.
Vicky had a question.
Fabulous.
Vicky, if you can recall what your question was, unmute yourself and ask. Anybody else have any questions? Now's a good time. Unmute yourself and just talk away.
Anybody
Anybody?
out there?
Also, if
space.
you want to order the book, we're not selling it. We are just giving it away.
Yeah.
Contact me, Marcia, that's MARSHA.Holland at Securities America. And we've already had some requests and those will go out today. So just let me know and we'll get them to you.
Great.
So those of you who want to go over the Morningstar, stay on board. It's pretty interesting. And if not, then we'll see you next week.
Marcia,
Yes.
will these recordings be available so that we can review?
Yes. They usually come to me later in the day and then I can get them out to you. I haven't done it before, so I don't know what kind of issues that I'm going to have. But yes, Karen, we'll get it out to you.
Thank you.
One issue might be, are we allowed to send them out before they go to compliance?
Oh, I hadn't even thought about that.
So accept our apology up front. Anytime I say anything, although I'm a speaker in a class here, I'm not promoting and selling. Everything I do has to be screened through our legal compliance department, and then we can put it out. So we'll try to record it and get it through them and see if we can put it up as soon as we can. But if it doesn't get up right away, please forgive us.
Yeah, and because it won't be immediate. It will be at least 2 or 3 days before they approve it. So thanks for the reminder on that, Bill.
Okay,
So,
I assume we can see the Morningstar page.
yes.
Okay, it's very small, so I'll tell you what we're seeing. Down here, this is a market index, and I can't imagine you can see this, but it tells me that the DJIA, Dow Jones Industrial Average, you know why I know that? Because I used to watch Louis Rukeyser, remember? 1979, we were talking about all this stuff. The market's up 334.9.